Hello and welcome to the Navigating Risks podcast. My name is Helen Yates and I'm editor of Global Thought Leadership here at Gallagher. Today I'm joined by Sarah Winstone, Executive Director of Trade Credit, and Aaron Hill, Business Development Executive in the Trade Credit team at Gallagher UK. In this conversation, we explore the financial layer of supply chain resilience, and I began by asking them what the impact was of a major insolvency on the supply chain.
I guess when we have a major insolvency in any given supply chain, there's a number of factors that affect both suppliers and end customers. So first of all, you've got an ongoing liquidity squeeze in the supply chain, which further increases the risk of default across the supply chain. You'll have perhaps delays in projects, which again creates pressure on supply chain. So one insolvency in the supply chain does put a considerable amount of pressure and liquidity squeeze on other suppliers and purchasers in that supply chain.
It's a bit like dropping a pebble into a pond. The sort of ripple effect can go out through numerous different companies, numerous different parts of the whole project, which is one of the big difficulties that, there may be somebody that's quite a long way down the chain, 2 or 3 back from the actual contract, that gets hit because there are other people that owe them money and they just can't, without, as Aaron says, without the liquidity, they can't keep going.
One of the things that we found when we did the Gallagher research earlier this year on supply chain risk was just how complicated many of these supply chains are in terms of the dependencies. Talk me through how that presents a challenge.
We've now seen a lot more interest for customers to credit check suppliers or ask suppliers to provide performance bonds and guarantees to secure the performance obligations. It is exceedingly difficult because you can only really check perhaps your direct counterparty or perhaps the second counterparty to your counterparty, and there might be perhaps hundreds of companies involved in any supply chain or any contract. So it is very difficult to do.
And I think the other side of it also is, as we've seen recently with the Straits of Hormuz, product can come from all over the world, and things like the ability of not being able to bring particular products get them to the UK because of issues, political or otherwise, becomes a real problem, in the same way that with Ukraine, the whole fertiliser business. But at the moment, the difficulty is getting the products that are required to manufacture fertiliser in the first place. And whilst you can try and find a way of getting product closer to home, a lot of it just is not available, and therefore it makes life much harder on everybody, and that then repercusses across everything that we as individuals find, because our product, anything that we might buy, goes up in price because everything becomes so much harder to obtain. And whilst you have shortages in stock, then that in itself means that things go up in price, and it just changes the dynamics of what people can do and what they can buy, and how they survive on a day-to-day basis.
I guess that's one of the takeaways for UK businesses, is that realization that events in another part of the world can have a direct impact on your business. And, you've mentioned the Strait of Hormuz and what happened with Russia, Ukraine. But I think we also saw that during the pandemic era, didn't we?
Yeah, and during the pandemic era, we actually saw quite a lot of goodwill between businesses to work together and to allow delays, and a lot of understanding that allowed supply chains, perhaps, which would have failed in any other situation, to actually continue to operate as best they can. So it was a very challenging time, COVID situation for supply chains, but it did also show us in some regards how resilient that they are. But it does require a goodwill between businesses, and also the strength for someone to support another member of their supply chain, which, once it happens repeatedly, what we would think of as once in a generation events, they appear to be happening every 2 to 3 years, unfortunately, at the moment. So that strength and resilience might be being tested.
Just to that point, one of the more interesting survey findings in Gallagher supply chain research was that when we asked respondents around the world, what the biggest risk was currently facing their business, And then they said it was the rising cost of materials, and you've both touched on that. Are there any particular industry sectors that are most vulnerable when you get this kind of inflationary impact because of supply chain disruption?
Well, I think one of the things coming back to the Straits of Hormuz and Ukraine and what have you is agriculture. And if you look at the farming industry in the UK, it's not only the products that they need to produce crops in the first place, but you then overlay that with the issues with the weather as well, to the point where it's getting to the stage where they're going through years where they're not necessarily even putting crops in the ground. And the irony of that is that we're buying product from overseas, which makes it much more expensive on everybody, which in itself is not going to help, you know.
You mentioned the increasing cost of fertiliser, which has an impact on the agriculture sector. Is that something that we're already sort of seeing now, or could there be almost like this delayed effect given, what we've had with, the Strait of Hormuz being closed, and then that kind of knock-on effect on energy prices, fertiliser prices, and all of those things?
Yeah, I think we're already starting to see it show a little bit in terms of retail prices in the UK and further afield. I think it's something, 30-40% of the world's urea comes through the Strait of Hormuz, which is one of the key components of most fertilizer mixes. So you might have a situation where at the moment inventories of fertilizer are there to accommodate demand in the short term, but they're already going through a destocking phase, which will mean that perhaps 3, 6, 9 months, that's when we see a lot of upward pressure in those kind of costs.
So tell me a little bit about the product, trade credit insurance, and what it does and how it helps clients, particularly those that are very dependent on their value chains.
Sure. So, in its simplest form, trade credit insurance is just there to protect non-payment situations where you're offering credit terms to your customers. Two primary triggers for loss are insolvency, that's any form of insolvency, and default, which is just late payment. So the availability of trade credit insurance gives comfort of security of payment through the supply chain, which helps liquidity flow. It's also a tool used primarily by banks and factors to offer invoice discounting products. And without the availability of trade credit insurance, we can see reduced appetite for working capital financing tools, which again further increases the liquidity squeeze if the availability isn't there.
So is this a product that's particularly useful during economic downturns, or should it be something that's sort of considered as an everyday kind of purchase?
Yeah, it's quite often, in our view, it's an everyday purchase that you need to be within the market for when unfortunate events transpire. Unfortunately, we tend to see a raft of inquiries for trade credit insurance after some sort of political event in a country or after some sort of economic event, which has already meant that the risk has deteriorated to such a degree that insurers are unable to cover the risk. So it's very much a product that you have to be insuring whilst in the good times, so to speak, and not looking to insure after the horse is somewhat bolted.
Because you mentioned that there were two triggers, so it's not just insolvency, it's also non-payment. So is that
Yeah.
where you mentioned like you can have a political event and that can cause issues?
Yeah, so it's any cause of the underlying cause of the non-payment. It's particularly we see a lot more insolvency claims in the UK and Western Europe because we've got very sound and strong insolvency laws. But perhaps in the developing world, insolvency laws are not quite the same. So we see much more instances of default, whereby the company's still trading, but they're just not paying for whatever reason.
Talk me through what you're seeing on the demand side for trade credit at the moment, and what does this reflect in terms of the current headwinds?
I think one of the issues that we have at the moment is that because there haven't been that many big losses recently, like Carillion, whilst there are a lot of small losses, as a market, the volume of claims isn't as high or as great as has been the case in the past. And so I think in that regard, we're up against quite a strong competition just to keep the premium rates at a reasonable level. I think that whilst there are a lot of new companies who are still interested in credit insurance, it's quite a challenge to be able to get them what they want and persuade them that it's a good buy, because as we say, it's not a mandatory insurance product, and therefore there are people, as Aaron was saying, who sort of they see a big issue and think, oh, we must go out and get ourselves a policy, by which point the insurers have already decided that they don't want to get involved in that risk. And so it's very much talking to people and persuading them that you need it in the good times as well as the bad times, because it then means that when things do start to go wrong, you're actually already in the game and ahead of those that don't insure. And I think that as time's gone on, the insurers are very much more attuned to the fact that not only do they need to provide insurance, but to enable clients to access a lot of the financial information and the information that they have and they receive, either from other clients about customers that they've got issues with on non-payment or late payment, but also what their general financial position is. So I think it's a lot of the background information that is becoming as key to the product as the insurance itself.
I'm pleased you brought that up, because one of the findings from the Gallagher supply chain research was that there's this huge demand for data and insights from insurance and broker partners. And that's a core part of the product, isn't it? It's not just the risk transfer, the risk financing element. It's also that other information that you get access to, isn't it?
Absolutely, because some of these insurers, the three largest insurers, have offices worldwide, then they have access to data on millions and millions of different companies, which actually makes the information they have far more up to date and useful to clients than perhaps some of the credit agencies provide, because they've got data from all their clients as to what they're seeing with regards to payment patterns, whether in a lot of cases they may well be able to get far more up-to-date quarterly numbers and management information than would necessarily be available to a credit agency. So certainly we're seeing a far greater uptake and also far greater transparency from the insurers as to sharing the information that they have.
We touched on agriculture before and the needs there. What other industry sectors typically would seek to take out trade credit insurance? What does a typical client look like? And is that changing at all?
It really could be any client in any sector that's trading on credit terms with other businesses, so B2B business. Classically and historically, you'd have quite a weight towards construction and metals and heavy type industries. But we're seeing a lot more interest from tech, from travel, that perhaps there wasn't a huge amount of insured in the market previously.
Great stuff. And why do you think that's changing?
I think historically there had been a requirement really for actual goods to be traded and transacted, but the market's got a lot more comfortable with service type companies in the last 5 or 6 years. So that's helped. We're also seeing more the general economy move towards tech-based and services. There's perhaps more potential insured or requirements out there than there was historically.
I mentioned before that in the supply chain research that we found that rising cost of materials was deemed the biggest risk currently facing businesses. I thought I'd tell you about the second and third risks on that list. The first being impact of tariff and trade disputes on uncertainty, and the third being geopolitical risks affecting flows and stability. One of the things that we see kind of being discussed everywhere at the moment, and in conferences around the world, is the fact that we're in this new world order now, and there has been kind of a shift geopolitically, and the world is becoming a bit more fragmented. Against the backdrop of all of that change, is it becoming perhaps more important that companies consider trade credit not just as an indemnification, but for those other insights that you talked about?
I think so. I think that way back in the midst of time, then companies that we would deal with in the UK, everything and their supply chains would have been within the UK, so they weren't necessarily quite so affected by things that happen elsewhere in the world. I think because the world is so much smaller with regards to products people want to buy and where they want to source the different components from, that it's become far more of an issue that things can go wrong thousands of miles away that affect what happens, next door, as it were. So in that regard, I think that it's important that people start, perhaps, if they are able, to look more closely to home and use what we have here rather than being quite so dependent on other countries. I mean, it is with the whole issue with gas, power, fuel, all those things make us far more vulnerable than we used to be. And I think that that's going to carry on being a key issue.
Yeah, it's interesting actually. We're writing a lot at the moment about the data center boom that's taking place to support investments in AI models around the world. One of the big factors in that is the need for power and how, and how that's changing things and prompting innovation, but also prompting more investment in things like renewables. So it's all these things kind of taken together do seem to make an impact over time, don't they?
Absolutely. I think it's only going to get worse rather than better. I think that the situation we're in at the moment, that it takes a lot of energy and enthusiasm to set up your own company. And certainly in the UK, given the inherent sort of blocks and barriers that are put in front of everybody. And the cost and power itself is a generation of that that's becoming more and more difficult. And it's the sort of key to keeping businesses going.
Yeah. And I suppose that's maybe a message for smaller businesses, entrepreneur-led businesses, that in order to compete, that the barriers to entry have gone down and that they can consider a product like trade credit to give themselves the buffers that they need. Can I just ask you, just in terms of the commercial insurance market, and you mentioned before that trade credit is a non-compulsory coverage. We know that prices have started to ease in the commercial insurance market after we went through that period where it was quite challenging. Does it now mean that non-compulsory products like trade credit are becoming a more viable option?
We're seeing a lot of extra capacity enter the market, either via MGAs or other carriers that have never written trade credit previously before. It is a good time to be insured in the market. Whether the situation in the Strait of Hormuz and potential increased inflation might not necessarily reverse, but hold that trend will remain to be seen.
That's all we've got time for today. Thanks so much for listening.